What's going on, guys? Welcome back to another video. In this video, I've got another very important AMC update to bring all of you this afternoon. So what we're going to be covering in this video is one, the option chain going into the next trading week. If you haven't fully understood this by now, when there's more calls or puts being held in people's brokerage accounts at any given time, it could potentially lead to more volatile price swings due to the institutions that are selling these options having to do a process called delta hedging. So if there's a lot of puts that could be going into the money, there could be a lot of selling volume that comes along with delta hedging those, and the exact opposite would happen with the call side. So we're going to take a look at that. We're going to do a brief Ortex update, and then we have some really interesting information to cover. So we've been talking about the overall market and how we're basically teetering on the brink of a major event. About every other day over the past couple of weeks, we have received more and more evidence that we are headed towards one of these types of events. Now, we don't necessarily know when this is going to be, even though there are some dates supplied in the articles that we are going to pull up on when some major economic events are going to happen. But again, no dates, no price targets. I personally am just buying and holding until we see something crazy happen. So before we get into all of that information, if you enjoyed the information and analysis that I provide for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you want to see more videos like this, make sure you hit that subscribe button. So AMC closed the week at 36.92. This was not the week that we were hoping for AMC. We were hoping to see a significant bounce off of the lows that we saw ending the previous trading week. But again, this is a super volatile stock. There's a lot of manipulative forces at play here, so patience is really a key thing to consider. Now, when we move over to Stonko Tracker, this gives us a really good picture of how many calls and puts are expiring in the money and out of the money at the current time, going into whatever trading week it is. So the trading week that we're looking at is next week, July 30th. So there's 9,700 calls in the money at the current time and about 20,000 put contracts. So what this is going to really tell us is how much delta hedging could we see on the call side and the put side? Now, these out of the money contracts right here are important to look at, but what we really need to pay attention to is the concentration of this open interest right here on whatever given strike it is. So when we come over and take a look at the actual option chain going into next week, for the call side, we can see that there's about 10,168 contracts at 40. If we rip up to close to or just above 40, we could see some additional buying volume be pushed into the stock. But when we change over to the put side, we can see that at this $30 strike on the put, there's about 18,000 contracts right there already. So if we do see a downtrend starting off the next week, we could see some additional downward pressure due to the market makers covering these options by delta hedging. And the way they do that is they actually go out and short the stock. So when we come over to Ortex, we can basically see that the utilization is relatively the same, 88%. The short interest on Friday went up 1.76%, and the short interest is currently at 14.77%. But again, I'm going to say this in every single one of my videos where we bring up Ortex, that I treat Ortex as kind of like a baseline number. It's kind of like, well, we're seeing that Ortex gives us about 85% of the total market data, and we know there's a lot of manipulation, naked shorting, synthetic positions, and hiding a lot of short interest on the option chain. So you can't take these numbers at face value. You have to take them with a grain of salt, but they are still very helpful to look at to give us that baseline. Now, let's get into this really large market disruptive event situation. So we have to talk about this new NSCC proposed rule change and something that Janet Yellen has been saying, in addition to kind of something of a stress test coming up at the end of next week. So when we come over here, Janet Yellen urges Congress to raise or suspend the debt limit by August 2nd. Treasury Secretary Janet Yellen on Friday warned Congress that her department will need to embark on extraordinary measures on August 2nd to prevent the U.S. government from defaulting if lawmakers are unable to strike a deal or raise the debt ceiling. After August 2nd, and barring a debt limit agreement, the Treasury will start taking extraordinary measures to pay for Congress's legal and financial default obligations, a temporary fix that allows the secretary to tap additional government accounts for a period of time. Now, these bonds are the avenue by which the U.S. finances all of its debt obligations. So it's kind of like issuing more debt to pay off existing debt. But this is not something that we really want to see at the current time for our market. When we come down a little bit further, it goes into the last time we would actually see this type of event. While the United States has never defaulted on its debt, recent history shows that getting uncomfortably close to it can create chaos. In 2011, House Republicans' refusal to pass a debt ceiling increase led to a downgrade of the U.S. sovereign credit rating that upset financial markets. But I highly doubt that the United States is going to default on their debt. But what I do think is very probable is that they do receive one of these credit downgrades. So back in 2011, one of the times that they have received one of these downgrades, what happened to the broad market? When we come over to the S&P 500, 2011 is right here. The S&P 500, the SPY, as we're looking at right here, went from about $136 all the way down to this $104, $105 range. This was a very significant decrease, and when we see drops like this happen, there's going to be a lot of margin calls, there's going to be a lot of forced liquidations, and that could lead to the start of the MOAS with AMC and GameStop, because they're going to just drain the liquidity out of a lot of these institutions, and they're not going to have any choice but to end up covering these shorts. Now, we've seen this short squeeze play with AMC and GameStop get drawn out over the last 7 to 8 months. So in my opinion, I do not believe that there is just going to be one straw that breaks the camel's back that is going to set off this squeeze. I personally think it's going to be a culmination of events and indicators working together that are essentially going to corner these over-leveraged institutions into having no choice but to cover these over-leveraged shorts, naked shorts, synthetic shares, whatever you want to label them. So when we come over to this NSCC report, this is NSCC 2021-803. As you can see up here, it's a 346-page document, but I do want to briefly touch upon essentially what they're doing here. So this has to do with securities lending. So what they're essentially doing here is they're creating like a separate spin-off clearing corporation for these securities lending transactions. So in addition to creating capital efficiency opportunities for market participants, NSCC believes that broadening the scope of central clearing at NSCC to SFTs would also reduce the potential for market disruption from fire sales. So this is a really interesting part of this filing. So what they're talking about with fire sales is that when securities are lent out, most of the time cash collateral goes to the lender. Now, what they do with that cash is they put it into other securities. But as we can see here, if the borrower of the securities thereafter defaults, the institutional firm lenders generally need to quickly liquidate the securities representing the reinvestment of that cash collateral in order to raise cash to purchase the originally lent security. So what they're saying here is that in a massive widespread wave of defaults, they're going to see a lot of these fire sales. So think to yourself very logically, why would they come out with this type of filing if they thought everything in the market was fine? If they thought everything was running smoothly, there would be no need for a lot of these different rule filings to come out. Now, what this also plays into is NSCC 002, the automatic margin call rule, and the rule where they can essentially remove members from the DTCC, whether it be from a cyber incident or they pose a great risk to the DTCC itself or the other members. So this is a really, really important proposed rule change that I encourage you guys to learn as much as you can about. But this right here really shows me that a lot of these regulatory institutions know something is terribly wrong with our market right now, and they are preparing to try to put out this fire or make sure that this doesn't get out of proportion. But again, I don't believe that they can do that because of how long the situation has drawn out and how over leveraged everybody is at the current time. So when we come over to this piece right here, shout out to Finn Watchdog for posting this information onto Twitter. We can see that next Friday, July 30th at 4:15, the Federal Reserve will be publicly releasing the total derivative exposure numbers of all the biggest domestic and foreign banks and their lending clients. What this essentially does is it opens the book on how over leveraged everybody actually is. Now, there are some avenues for the Fed once they see these numbers to actually come in and force these institutions to maintain these regulatory standards and come back up and essentially de-lever a lot of their positions. But again, no dates really. I don't want to put out dates for you guys, but we do have that August 2nd date with Janet Yellen and this Friday, but these are mainly more economic dates. But for AMC and GameStop, this could take a while. We have been waiting around for this short squeeze to take off, and the due diligence has been done, the research has been done, and the only thing that we are really seeing change on a day-to-day basis is the price that we are seeing on our screens. So for that reasons, I am still buying and holding, but nothing I say in these videos is financial advice. These are for educational purposes only. So that is going to wrap up this update on AMC. If you enjoyed the information and analysis that I provided for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video, so you get to stay up to date on all of your favorite stocks, learn about a couple of new ones, and see exactly which options I am trading and which strategies I am using to trade them. So I hope you guys are having a great weekend, and I'll see you guys in the next video.